Yeah, it's a strong set of numbers, Steve. Profit after tax of 854 million, up 79%. As you said earlier, total income up 73%, cost income ratio 41%, and ROTE guidance for the year now above 20%. On the back of the very strong set of numbers we've had in the first half of the year and continuing momentum in the business, we're going to be raising our guidance for the full year in terms of our net interest income. We're now expecting it to be in excess of 3.6 billion, which is another 10% uplift to our guidance for this year.
Excuse my ignorance, and I have a vast amount of ignorance, as you'll know from my lines of questioning, but your NPEs is only 3.3% of gross loans compared with in December at 3.5%, so your non-performing exposures. Why isn't that getting worse? I thought bankers started to worry when interest rates move up this aggressively.
Well, I think it's a reflection of a number of things. Firstly, the quality of the underwriting we've been taking over the course of the past number of years. We have, post the global financial crisis, our NPEs topped out at about 30%. And the legacy pre-COVID NPEs are now at 0.3% of gross loans. We've worked very hard, most of it working with our customers on a case-by-case basis in restructuring our loans. And we remain alert to the dangers of higher inflation. We remain alert to the dangers of tightening monetary policy and how that impacts on our customers. But we're not seeing any signs of distress coming through the book at this stage.
You've got a lovely green screen behind you showing all the amazing development down the river that's happened in the last 10, 15 years or so. But I just want to take a step back. Do you think you and the rest of the Irish banking sector are kind of almost generals who look back at the last war and thought, we just don't want to go there again? The Celtic Tiger, the bursting of that, the government ownership, we just don't want to go back to those bad old days. Do you think that's why these numbers are so robust? Because you've got a psychology just remembering what happened last time?
Well, I think we're all very conscious of the fact that banking is an industry which tends to overlend at the top and underlend at the bottom. And our approach is to lend on a consistent basis right the way through the cycle. Conservative, prudently managed, prudently provisioned banks don't get into trouble. And it is in the best interests of our customers and indeed the economy that we serve and the society we serve that we keep the bank as robust as possible. So we do unashamedly take a conservative approach to our underwriting right the way across the book.
Does it matter about the government ownership? I'm sorry if I've asked you this before, but I mean, they're down now. What are we? Down to 46.9, I think I just had a look, Colin. Does it matter if the government still hangs on? Is it a sign of strength if that they sell into any rallies you get on the back of your share price, which is up dramatically from the lows?
Well, at the start of last year, Steve, the government shareholding was above 71%, so the free float was less than 29%. And over the course of the last 18 months, we've seen the government lightening its exposure to AIB, reducing its shareholding holding in AIB by a cumulative 25%. The big impact, of course, there is that it significantly improves our free float, which significantly increases our liquidity and is warmly welcomed by investors. And, of course, is one of the reasons why the bank has been doing so well in terms of share price performance.
Colin,